Well, here I am. Hello, I'm Mitch Goldberg. Welcome to Be the Boss of Your Money. I want you to be the boss of your money, not your money to be the boss of you. It's very easy for that to happen, by the way. So, this show is about personal finance. It's about educating you about money, about loans, about investing, about personal finance. Well, we said that, but it's about establishing a will. It's about taxes. It's about all of these things that come into play when we talk about personal finance, financial literacy, business talk, okay, investing tips galore, galore. So I'm Mitch Goldberg. Thank you so much for watching. Today we're going to talk about probably the most important topic there is in personal finance, and that's the subject of interest rates. And it might seem really boring because I think it is kind of boring until you realize what interest rates could do and what they are. Just want to make sure you can hear me okay. The mic sounds a little funky in my end. Okay. So interest rates play a role in literally everything we do that has anything to do with finance, whether if you're a borrower, an investor, and we're all pretty much one or the other, or even if you're just a saver, if you're a spender. So interest rates impact literally every facet of our lives. And I want to not just give you like the current state of interest rates, I want you to know how interest rates impact you, how they impact your finances, how they could impact your ability to even retire, how you're, to fund your home purchase, to fund your advanced education, to fund your children's education, et cetera. So interest rates are really important. And it sounds like this esoteric thing, interest rates, and it's like, I don't want to hear about it. It's just easy. I think following the stock market is, and getting into stocks is a lot more exciting than just looking at interest rates. But one of the drivers behind the stock market, I'm going to just eliminate the headset for now. One of the drivers behind the stock market is actually interest rates. So, we've had such low interest rates for so long that I think people are used to it, especially if you're like under the age of like 45. You're very used to low interest rates. If you're over the age of like 60, then you're still pining away for those days when it was normal to earn 5 or 5.5% interest in a money market at the bank. Those days are long gone. And if you're like me, kind of in the middle, you're like, I miss those days, but it is what it is. And we just have to adjust. But I also think that a lot of investors are making a very big mistake by trying to chase yield by buying risky or speculative investments because they're paying a higher yield. Remember, interest rates affect savers and retirees the most. Low interest rates, because these are the people who have saved money and they can't live off the interest from the bank or from bonds, so they're going into more and more dividend paying stocks. So don't get me wrong, I love dividend paying stocks, but stocks are still stocks, they're still risky. So let's just roll the quick intro, then we're going to get into just a quick market summary, and then we're going to get into bonds, what they mean, what they really are, and even like, should you take an adjustable rate mortgage and lock it in now, things like that. You should know about these, and that's what personal finance is all about. So I'm going to roll the intro, and then we're going to take a deep dive into interest rates. Very interesting. Hmm. All right. Thank you so much for joining me. I greatly appreciate the time that you give me. And I want to make sure that I'm giving you value because your time is precious. And I want to make sure that the value that I convey to you is really well worth it for you. So I'm going to do that right now. We're talking about interest rates. I want to welcome you to my live stream show. It's called Be the Boss of Your Money. It's a show about personal finance, investing tips, business talk, and that includes a lot of topics, but ultimately it all has to do with making you the best possible version of your financial self. If you have any questions, I'd love to answer them. So if you're watching this in live stream, welcome. Hit me up in the comments with your questions. And if you are watching this in the replay, hit me up with your questions there as well. I mean, I will get the notification when you ask me a question. Maybe it's important. Maybe it's something that you just want to know right now. Words of wisdom are always valued here as well. Share your experiences with me in the comments. I think if we can all benefit from it, and if you're not too shy about that, and let's roll with it. So first, what I always do is I do a quick market summation, the stock market, and then we're going to get into the big topic, which is interest rates, because interest rates are everything. Like, I should put that on a t-shirt. Like, interest rates are everything. Interest rates conquer all. I mean, love conquers all, but interest rates could maybe conquer that. Let me just roll with it, okay? Let me just share the screen here and give you a better view. Okay. Boom. Stock market was off about, just about 100 points. No biggie. S&P off a fraction, 7.5 points. NASDAQ off 31. No big deal. Russell 2000 off a little bit. I mean, the Russell 2000 wasn't down quite 1%, but the reason it's down has more to do with, I think, the arguing back and forth about stimulus in Congress. And the VIX, the volatility index, also known as the fear gauge, comes in a little bit further below the 30 mark. I think one of the reasons the VIX is still elevated, and typically that would be in the green when the stock market goes down, but the VIX to me has been elevated because a lot of investors are hedging their bets. That's what the VIX is. It's when the VIX goes up, it tells you that professional traders, money managers are paying more to hedge their bets. A lot of people are worried about dislocations in the market caused by the election. Okay. Anyway, I'm not too concerned with today's down action. Yesterday, we spoke about the bull case for stocks. We're going to continue that a little bit today. There is a bull case. We have to talk about that. Look, we kind of get into the negatives all the time. And you always hear people say, oh, but, the bad event passed, but we're not out of the woods yet. Let me tell you something. We are never out of the woods. There's always a new crisis. There's always another dark cloud on the horizon to be worried about. But the point is, you have corporate America executives who are doing everything they could to create value for customers, for shareholders, for employees, and ultimately, that's what makes a capitalistic system work. That's why capitalism is so great. That's why we're big fans of capitalism here on Be the Boss of Your Money. Okay, so let's just take a quick gander. These are the sector ETF. These are the ETFs that represent all the sectors. Communications had a decent day. Consumer staples had a decent day. When you see consumer staples toward the top of the chart like this, it's not a huge vote of confidence for the economy. But I never let one day make an impact on me. It takes a trend, not a day. One day is not a trend, and 3 days is not a trend either, by the way. Some people think, 3 days is a trend. No, it's not. Okay. So financials were off a little. Look, everything was off a little bit, but everything was up a little yesterday. It's just the give and take. We've had a lot of corporate earnings come out this morning, and some today. And overall, numbers have been coming in really good. I mean, seriously, some of the companies that are reporting have come out with numbers that have been not just above expectations, but solidly above. And I think very good. One reason for that is because of something called operating leverage. Companies have gotten so good at cutting costs over the last 6, 7, or 8 months that now a little bit of extra business goes right to the bottom line. Okay, let's take a look at the FANG stocks. Okay, Facebook was up 4%. Go by the percentages. Facebook was up 4%, but Apple, Amazon were down. Netflix was down. Google up a little. Microsoft up. But I would have to say about an even day for the FANG M stock. So without a lift from the FANG stocks, it's pretty hard for the rest of the market to get much going, either, upside. Let's take a look at the reopening stocks. Yeah, they were down. American, UAL. I mean, these aren't dramatic moves. Royal Caribbean, Planet Fitness was up a touch. Southwest Airlines, Marriott Hotels. Nothing major. It was a really, I have to say, it was a really quiet day. And we're going to talk now a little bit about interest here. So I'll just stop sharing the screen for a second. So today was just a very quiet day in the market. I wouldn't read anything into it. We're basically 13 days away from the election, and I don't think anybody really wants to do anything. I think, the big bettors, the big market peeps on Wall Street have made their moves. They've made their decisions already, and now they're just, they've executed their plan. Now they're just waiting to see how the election turns out. Right now, it's. I think people are comfortable betting. There's not a call if people are comfortable with a Biden or a Trump win. I just think that, whatever is going to happen, probably a Biden win is factored in. So people have made their bets, and I don't think anybody really wants to change anything until they get past the election. That's what I think it is. So I expect some very quiet days coming up. I don't expect a crazy up, crazy down. It could happen, but I don't really expect anything out of the ordinary. I expect a couple of boring days, unless something major pops up in the news. We've got the debate, the last debate coming up. Unless somebody faints on stage or something, nobody's mind is going to be changed. I think everybody just wants to see how it goes with the muting of the mics, to see who keeps screaming and talking once the mics are muted. It's going to be interesting. So I just for that value right there, I think people are going to watch it. If you have a question about any of this stuff, please ask me in the comments. So, but there's no stimulus yet. I don't think anybody expects a big stimulus package to be passed by Congress before the election. Early next week, we've got the vote coming up on the confirmation of Judge Barrett for the Supreme Court. So that's the next thing. But after that, it's just too acrimonious. The Republicans are pushed for a $500 billion vote today. It couldn't pass the Senate with 60 votes because the Democrats knocked it. They killed it. So there's nothing going on. And even if you get a $2 trillion stimulus that the Democrats and the White House agree on, I don't think they'll get enough Republicans. I don't think they'll get 60 votes. They need 13 Senate Republicans to join them. I don't think they're going to get it. So it's just basically nothing. It's a shame for the people who need it, and that's really, we have to remember the human part of this. So that's why you just had the market not do anything. I wouldn't be surprised after the election if we get a 5 to 10% hit in the market if we don't get any stimulus before the end of the year. I don't think it goes lower than that, even if we get that, because I think investors will just be expecting a stimulus from the next administration, plus a big infrastructure bill as well. Let's talk interest rates, okay? Interest rates are also known as the cost of money. What do you mean the cost of money? Well, money is money, so how could money cost money? Well, there's an expense. When you borrow money, you're paying the interest rate. So if you borrow $100,000 and you have to pay it back in a year with 5% interest, then you have to pay $105,000. So that cost of money is $5,000 for the year. There was a time when 5% was a reasonable interest rate. Now, when people who have to pay 5% are like, I would never pay that kind of yield for anything. That's just the environment we live in right now. But there have been times when interest rates were double digits in a savings account. So we've seen everything. It's hard to imagine right now interest rates going up to double digits for a savings account. And it's also hard to envision paying 10% for a mortgage, but we have seen those days. So what I want to talk to you about is a couple of things. So if interest rates go up, what does that mean? Well, your credit card bill, even if you don't buy anything else, and if you don't finance anything on your credit card bill, just by the interest rate charges going up, you'll have to pay more to fund past purchases. You see, your past consumption, if you're paying interest on a credit card, your past consumption, the crap that you bought in the past, is now costing you a lot more money and hurting your future ability, your current and future ability to save money for the long term. So if you bought something a couple of years ago and you paid for it and you loved it and you enjoyed it, great. But if you're still paying for it and whatever you bought is sitting in your attic or your basement or your garage, or you bought stuff over the years and you don't even remember what the hell it is that you spent all the money on, you're paying the interest, you could see why it's so important to carefully consider what you spend money on. And I have a little money rule. I share this with my kids. Wait. Because a lot of times when we want something, if we wait, the urge often goes away and we don't want it anymore. But there are a few things that we focus on that really builds up the dopamine in our brain, and those are the things that we start to want. Maybe those are the important things. So, and maybe that's a better way to make your spending decisions. All right. So, what about mortgage rates? Now, think about this. Everyone knows that the price of a house has gone way up all over the United States. Yeah, it's up a lot more around the big cities on the coast, but it's gone up everywhere. Nobody's immune to it. Even places that people thought were so cheap, like even the Carolinas, which, depending on where you're coming from, that's all gone up. Nothing is really cheap anymore, relatively speaking, to even just a few years ago. So why? Because people buy houses based on a payment, on a mortgage payment. And if your mortgage payment is really, really low, it could still be worth it for you to pay for a house that maybe was $400,000 10 years ago, and now it's $600,000. It could still be worth it to buy it because the mortgage payment is so low. And if you compare the mortgage payment to your rent, maybe you're really thinking, this is a pretty good deal. I only care about what I'm paying. Okay. Now, you may never make money on the sale of the house, but at least your payment is low. And that's what people are making the decisions on when they buy a home. Look, there's never a guarantee that you buy a house and sell it for more money than you bought it for. And if you factor in things like the interest that you pay for the house and the upkeep and the maintenance and all the repairs, I think people make a lot less money on houses than they often think. When people say I bought a house for this and I sold it for that, I'm like, let me see all the expenses and all the bills and the interest that you paid along the way. It's probably not as great as you think. Okay, that's a debate for another day. But if the cost of the house goes up, if the mortgage rates go up, interest rates go up, well, maybe you can't afford that $600,000 house anymore, and you have to step down to 550 or 525, as in this example. But if that happens across the board, because if mortgage rates go up, they're not just going up for you, they're going up for everybody, that could actually take some steam out of the actual cost of a house nationwide. So we could see that happen. It does happen once in a while. Houses do drop in value once in a while. So that's another thing. So the housing market, and basically the whole real estate market, is really a function of interest rates. When interest rates are lower, you can mark up prices more because they cost less to carry because of the lower financing cost. You probably understand that. But what you might not realize is that this also affects, want to make sure I go by my notes. I'm following a game plan. So every time I come on the air, I follow a game plan to give you value, not just shooting off the hip. Sometimes I could do that, but I want to really make sure I follow a game plan. So stocks and bonds. When interest rates are low, okay, it makes stocks more competitive. For example, stocks that pay a dividend look better. Because, a stock that pays, let's say, a 4% dividend looks really good when your money market or savings account in the bank is only paying 0.01%. So even if the stock goes up a lot, now the dividend yield is only 2%, it's still attractive based on interest rates. Never mind that the stock has gone up and stocks could be risky. But stocks are pushed higher in many cases by lower interest rates. And it makes growth worth more because typically you get lower interest rates, in a slower growth economy. Weakening economy means lower interest rates. So if lower interest rates come around, a lot of stocks with growth, it's like the lower interest rates go, the more their growth, the stock's growth is worth. So then you get companies like the FANG stocks, like the Facebooks of the world, the Apples of the world. Okay. You know what I'm talking about. The stocks we talk about here every single day, a Salesforce.com, for example. These are high PE stocks considered expensive, but super high quality and dependable growth. But what happens is when interest rates go down, their growth becomes worth more. Their PE ratios or PE multiples expand. And what happens is if interest rates go up, and everything works in reverse. And then all of a sudden you get lower valuations. So that's how it affects stocks. And I want to say the last time we saw a spike in interest rates that really scared the market was the fourth quarter of 2018, just about 2 years ago. We saw a pop in interest rates and the market plunged. And it was because we saw a pop up in inflation. Interest rates went up fast. So rising rates is not necessarily a bad thing for high flying stocks and for the overall stock market. It also depends on the velocity of how quickly it goes up. By the way, Ryan is out there. Thank you, Ryan. I think people, me included, mistake real estate investing with home buying. Investment properties make money, homes take money. Yeah, you know what? That's really well said. I like that. I think you should make a graphic, Ryan, with your handsome face and put that in there. That is a very good one. I like that a lot. Thank you for sharing. By the way, Phil, I see you out there. I'd love to have a phone call. Okay, but I can't do it right this second. Okay. Next couple of days would be fine. You're always welcome to call me, by the way. My number is out there for public consumption, so everybody can give me a call. I'll share my number with everybody now. Okay, my phone number and email address right there. You see it on the bottom of the screen. There's my number, scrolling right there. Okay. So stocks are impacted by yields, but not by interest rates. So when interest rates go lower, a company with, let's say, 10% growth in their earnings is really great. But if interest rates are at 10%, well, that growth rate of 10%, it's okay, but I could get 10% in the bank. It makes a 10% growth rate not as competitive. But if interest rates are close to zero, like they are now in short-term yields, and only about 0.8% on the 10-year treasury, well, a company with 10% earnings growth is worth a lot more. And you pay up for that stock. It goes up a lot. So all the valuation metrics we use to value a stock expand. So when interest rates go up, it could go in reverse. Now, typically when interest rates do go up, if interest rates rise rapidly, like just a sudden pop up in interest rates, that typically, from my experience, takes the whole stock market down with it, because it's a sudden dislocation. It's risk off. People are just blowing out of their stocks, their funds, et cetera, their index funds. By the way, you cannot invest directly into an index, but you could invest into an index fund or some investment, that tracks or mimics an index. Okay. I just want to throw that disclaimer in there. So it's risk off, but then people go back and say, well, what could make money? Typically, when the economy is getting stronger, inflation's picking up a little bit. What starts to do better are financials like commercial bank stocks, industrials, materials, energy, and consumer discretionary stocks. So that typically is a good place to be. And I'm going to show you, and I'm going to show you the yield curve. I'm going to show you the interest rate spectrum right now, and this is really important. And if I'm getting a little wonky here, I'm sorry, but this is how it's got to be explained. If you take a look at this, the 1 month T-bill is paying 0.08%. Okay. And then your 3 months, it's a little higher, 0.09. And then you go 6 months out, it's 0.1. Then you go a year out, it's 0.1, 1 to 0.12. Then 2 years, 1.4. And you see that these numbers keep going up. So the longer term you go out from a month See that over there where my cursor is to 30 years? Interest rates typically go up. That's called a positive yield curve. Short-term rates are low, long-term rates are high, and you get a chart, a sloping chart. Okay, so that's what the yield curve is telling you. And when that happens, typically that's an indication that the economy is either expanding or going into expansion mode or recovery mode. And make no bones about it, the economy is doing a lot better than it was last March and April. And yes, we need the stimulus. We could use a stimulus from Congress. If you don't get it now, though, I think investors will hang in there with their positions and not blow out of the stock market because they are confident that we'll get a stimulus, maybe in February or March. So it's not that long for investors to wait. It's an eternity if you are depending on stimulus and you own a small business, though. So that's the human side that we have to pay attention to as well. We're talking about the bond market and interest rates. Okay, so the yield curve is steepened, and this is not only is this a very bullish indicator for the economy, but it's also a pretty bullish indicator for the stocks, the kinds of sectors that I just mentioned. Again, industrials, financials, energy, materials, and consumer discretionary. Okay. And those companies typically are not the high flyers right now either. The tech stocks mainly, and you know the names of the tech stocks, they're the ones that went up the most. They also benefited from the work from home, the stay at home, and all that. But they've gone up the most because at least they have growth during this horrible, pandemic-induced recession. So they've gone up a lot, and the low interest rates have really pushed a lot of people into those. So that is how interest rates work, and that's how interest rates affect the economy. They affect spending. If we spend less, right, the economy gets hurt. But they change things around. They affect everything from mortgage rates. The cost of money changes when interest rates go up. The cost of money goes higher. And it doesn't matter if you are a saver, a consumer, a borrower, a lender, a spender. Interest rates affect every facet of our lives. I hope this helps you with your understanding of interest rates. If you have any questions about this stuff, definitely hit me up. It's hard to explain everything about it, I guess, in a half hour. Did my best. I'll see you tomorrow. I have a couple of guests coming up, by the way, next week. I've got Chris Lowenberg, who's a CPA. We're going to talk about the Trump versus Biden tax policies. And then I've got Leslie Tain, an attorney who owns the Tain Law Group, and she is incredible. She knows all about consumer finance and paying down debt, getting out of debt, and she has the whole legal thing, and she's an expert with credit, bankruptcy law, everything. And I'm going to talk to her also next week. So stick around, and I'm going to be having a lot more guests for the rest of the year. All right. Speak to you soon.